Okay, I'm going to show you how to do the adjusting entries. This is related to workshop 3 of the Strategic Information Systems class. Then we stopped here, we did this exercise, the DVD business case exercise, and then we ended up here. We were about to start the adjusting entries, okay? And the first adjusting entry, it says record Dana's salary. Then if you remember in the case, we had mentioned before that we had hired Dana, and in the accounting we did nothing because Dana just hired the contract, and then she started to work at the beginning of the month. Then here it is mentioned that we're gonna pay Dana until July, but at the end of the month we gotta recognize that we use the human resource of Dana, okay, even though we are not paying her. Then what we have to do is in our adjusting entries, then we gotta go here, and then here we gotta select salary expenses, okay. Then here you can do something like we did the data validation. Then we can select list, and then we can select again the chart of account, just to select the account from the chart of accounts, and avoid searching for the result. And right here, what we can do, for example, here for this one we gotta select salary and wage expenses, because we gotta recognize that expense, okay. And this one is 7,500, okay. And the other account that we have to, I'm gonna copy this until here, okay. I'm gonna Control Z to come back. Then, okay, I want to copy it, and I want to delete the information here. Then the other account that I have to credit is wages and wages payable. Okay, this is wages payable for the same amount. Okay, then now we are done with this expense. We are recognizing that expense. Then we go back to the following. It says recognize incurred rent expense. Then, as we have seen before, we had paid the rent in advance. Then now we have to recognize that we already used that resource, okay. Then what we have to do here is to select the rent expense, and then type 15,000, and then select advanced payment. We have to cancel out that account. That is basically an intangible asset that we had defined, right? We could name this account such as rent in advance or something like that, but I just name it advanced payment, and now we recognize that expense. Then we can go to the following one. It says bills totaling 4,500 for telephone and other utilities for the month of June are received on June the 30th. Payment will be made in July. Okay, then right here we gotta make the recognition of that expense, that is utility expense, and we search for that. Utility expense is here. That is for 4,500. We debit that account, and since we are not paying that with cash, then we gotta select accounts payable, because we will pay that later, okay. Accounts payable equal to the same, okay. Now we go to the following one, and it says record interest accrued on the bank loan for 1 month. And this one, if you remember, the interest, the loan that we had got was 100,000, and the interest rate was 12% yearly, okay. Then we gotta recognize just the interest. Then in this case, we have to debit. We gotta select an expense account, because the expense accounts are like the assets account. They increase when you debit. Then we select which account, interest expenses, because we have to recognize that expense, right? Even though we are not paying the interest, because it is mentioned in the case that the interest and principal are going to be paid at the end of the 3 years of the loan, okay. Then we search the interest expenses, and right here it is, okay. Then the amount is, since this is 12% annually, we're gonna divide that one by 0.12 divided by 12, that is monthly, and now multiply it by the amount of the loan, that is 100,000. Okay, and now the interest that we have to, the interest expense we have to recognize is 1,000. Then since we are not paying this interest, we are just recognizing the expense, we gotta select interest payable, okay, that will be paid in 3 years from now. Okay, then we are done with that. And we go to the following one. It says Dana estimates that approximately 80% of the supplies purchased early in June remain on hand at the end of the month. This means that after the month we bought supplies. Supplies are like paper, pencils, and those stuff that are used daily in an office. Then it says that 80% is remained, and that means that we spend 20% of the supplies on hand. Okay, then we gotta select the account. Is supply expense. We gotta recognize that expense, and that is a supply expense, right? And the amount is gonna be 20% that we spent times the amount we bought. That one is from here in supplies on hand. On June the 3rd we bought that one. Then we basically spend 1,500. Okay, and then we have to credit supplies on hand just to reduce the amount of supplies on hand we have. Okay, and we debit this one. Okay, and we go to the next. It says we have to record straight line depreciation for the DVDs and the computer equipment for 1 month based on expected 5-year lives with no salvage value. And also we have to record a straight line depreciation of the shelves and fixtures based on a 10-year life with no salvage value. Okay, in this case, we gotta remember how to calculate the depreciation expenses using the straight line method. Then in this case, we have to recognize that that's an expense, even though that is a non-cash expense because we do not pay anything. But we have to recognize that our assets are exhausted a little bit. Okay. Then we search for the account depreciation expense. We're gonna debit that account, and we're gonna credit another account that is called accumulated depreciation, that is gonna be used for accumulating all the depreciation over time. Then what is the amount? Okay, right here it's gonna be let me show you. It's gonna be it says that 5 years for the computer equipment, then that is 20% every year that we are gonna calculate the depreciation every month. Then the 20% that is every year, because it's going to be depreciated every until the 5th year, and we divide that one by 12. Now we put the amount of the computer equipment, that is this one, and also the value of the DVD inventory. Okay. Am I right? It says yes, the DVD and the computer equipment. Okay. Then all these two are depreciated in 5 years. Then I use a 20% rate, right? And then divide it by 12. Then I want to add now the 10%, because the shelves are gonna live for 10 years. Then it's 10% every year. Then I will divide it by 12, and I multiply by the amount of the shelves and fixtures. Then, right? Then I got 3,125. That is the value of the depreciation. Then I finish with that one. Then I just have to record the income tax. But until now, I have to recognize the income tax expenses. Then I gotta go search for tax expenses, tax expense account. That is tax expense account, rent expense, income taxes, and here I'm gonna put taxes payable. Okay, so I'm gonna be paying taxes later on. And right here I do not know how much they are, but if I go to the financial statement, this everything now with that we fill out the journal, the ledger is gonna fill out automatically by you for you, and the TV worship as well, okay, and the financial statements, okay. But before that, what you have to do is put all this debit and credit in the TV worksheet that I already did it here, okay. Then what you gotta do is here in your sheet you have empty values here, but you gotta be searching exactly what is this account is salary and wages expenses. Then you gotta search for that, then write this here, then you can put equal to the journal D34, that is this one, okay. And you fill out all this and this, right? That is exactly what you have here, okay. And once you do so, then in the financial statement the income tax is calculated for you automatically. Then from here you can just type equal to, then you go to financial statement, select the income taxes, and then you type equal to this. And then once you do this, you gotta check that your balance sheet got a balance. You have a total of 428,375. That is exactly the same, okay. And if you follow my steps, you should be able to have exactly the same balance sheet, okay, with the same income tax, with the same net income of 16,012.50. Okay, now what the rest that you have to do is to fill out the financial statement variables. Then you have to read my note about financial statement analysis, and also you gotta calculate the ratios according to my reading and according to this business case. I hope you got the idea.